Good afternoon. Thank you for joining us today. I'm Lori Siskin. I serve as Secretary Treasurer on the MAPERS Board. A copy of today's presentation can be found on the events page of the MAPERS website. And a link to the handouts is also included in the reminder email that was sent to all the registered members this morning. Today's webinar is sponsored and presented by Macquarie Investment Management. We're going to ask you to please submit any questions you have for our speaker using the Q&A buttons on the Zoom app. Questions will be answered at the end of the presentation. Now, Chris Jacques, Vice President, Client Solutions at Macquarie, will introduce today's speaker.
Thank you, Lori. And we appreciate everyone joining us this lunch hour for this update to Daniel's presentation on the impact of COVID-19 on the global economy and markets last year. Just like Lori said, my name is Chris Jacques, and I work with Macquarie Asset Management's Client Solutions Group based out of our Chicago office. For those that may not be familiar with Macquarie Asset Management, we are a research-focused active manager with $414 billion in assets under management, with roots in Sydney, Australia, and a presence around the globe. We are focused on three main areas: equities, fixed income, and private alternatives. And backed by popular demand, presenting for us today will be Daniel McCormack, Chief Economist for Macquarie Asset Management, based in Frankfurt, Germany. Daniel is one of our esteemed thought leaders at Macquarie, and him and his team help provide global economic insights and support for our clients. Before joining Macquarie, Daniel worked at the Reserve Bank of Australia in international economics, where he researched globalization, the causes and effects of a financial crisis, and monetary policy. Daniel, thank you for joining us this afternoon.
Thanks, Chris. Thanks, Lori. And hello, everybody. Great to be with you again. Today, I thought I'd talk to you about a few things. Firstly, what the outlook is for the global economy and what that means for the different asset classes. Secondly, I'd like to share with you some work we've been doing on this inflation risk issue. And then lastly, just touch on some of the themes that we mentioned this time last year and just see which ones of those have played out and which ones haven't. Just to do a little bit of a recap on kind of what we said, this time last year. So the title of the presentation, navigating the strongest recovery for 40 years, because that is what everybody is forecasting. Just on the first slide here is global real GDP. This is cumulative since the peak in 4Q 2019. That the dark blue line here is the current COVID downturn, and just comparing it to what happened during the GFC. And as we all know, much sharper drop in GDP, much sharper rebound. Where are we at now? Well, we're about 0.5 percentage point below the pre-crisis peak, which is tracking pretty well relative to the GFC, right? The GFC was a much more drawn out recession, and we were much further below the peak at the same point in that downturn. What's the outlook from here? Well, everybody is just universally forecasting very strong GDP growth. So the IMF just released their latest updates, and they have 6% global GDP growth forecast for this year. They have continued strong growth after that, so 4.4% next year, 3.5% the year after. The long run average, 1980 to 2019, is 3.4. So you've got 3 consecutive years of above trend global GDP growth now being forecast. In fact, the forecasts now are so strong that had you taken the growth rate in 2019, assumed COVID didn't happen, and just extrapolated that 2019 growth rate out, you would end up in the same place at the end of 2023 as what you do based on the current forecast. So there's some extremely strong growth rates in there. What's driving that? Well, it's just a simple return to normality, right? Simple return to normality, the release of the pent-up demand that comes with that. And that, of course, is being fueled by this huge amount of savings that households have built up through the crisis, courtesy of the fiscal support, I would add. But that is what is really driving the recovery. I tend to look at these forecasts and think, what's the balance of risks to that kind of picture? In my view, they're tilted a little bit to the downside. I think in the near term, there's no doubt we're going to see a really strong surge in economic activity. But I guess sort of late 3Q, early 4Q, I think there's some risk that these numbers disappoint. And I'll talk about the reasons for that, but it's just got to do with, who's done the savings and the extent to which they're likely to spend those savings going forward. Just also makes me nervous, right, that every forecaster seems to be falling over themselves at the moment to have the strongest numbers on the street, to upgrade their numbers. That just always makes me worry that the risks are to the downside on those numbers. What's going on in terms of COVID? Well, unfortunately, in terms of COVID, the news hasn't been great. Left-hand graph on this slide just shows that cases have actually been rising globally, both in terms of infections and, unfortunately, fatalities. The middle graph makes the point, though, that this is really very much concentrated in the non-OECD part of the world. And in fact, the non-China emerging market part of the world. So it's India, it's Brazil, it's LATAM more generally. And as the right-hand chart shows, although from a human perspective, these are tragedies. From an economic perspective, these economies are just not that large, from a global GDP perspective. And so we don't think this surge that is going on is really enough to derail the recovery. Now, of course, if a variant came out that was resistant to the vaccines and that spread globally and everybody had to shut down again, that would completely change the picture. But that's not what we're anticipating. The really good news over the last 6 to 9 months has been what's been going on with vaccines. So firstly, the efficacy of the vaccines has been truly remarkable, right? There was no guarantee that they would be that good at preventing COVID, but it turns out they have. The scientists have done an outstanding job in that respect. The second piece of good news is the speed of the rollout, right? Now Israel is leading the pack here, but the major developed world economies have done a very good job in terms of rolling this out quickly. So the UK also was very fast in this regard. The US as well has been rolling the vaccine out with speed recently. Now, Europe was lagging, and that was a problem, but Europe recently has really picked up pace. You can see this in the right-hand graph. The rate of rollouts of the vaccine has accelerated across Europe. I'm here in Germany, and the pace here has just been extraordinary recently. They keep setting daily records all the time. France did 2.5 million vaccinations last week, right? I'm actually going to get my vaccination on Monday. I'm in my 40s, and there is talk. I sort of have priority because my wife happens to be pregnant, but that appointment came in the space of about a week and a half once we applied. And there's even talk now that they will abandon priority altogether and just allow anyone who wants a vaccination to make an appointment and come along and get it. So originally, European politicians were talking about herd immunity levels by perhaps the end of the summer, and they're now talking about that possibly being reached by the end of June. So I think there's a real chance now that on the continent, things are pretty normal come summer. What does that mean economically? Well, the US is currently growing very strongly, so no real change to that picture. The UK opening up as we speak, right, through April and into May. We'll see really strong growth in the second quarter after a contraction in the first quarter. Europe will see contraction first quarter, growth probably in the second quarter, but not as strong as the UK and not as strong as the US. But from the third quarter onwards, i.e. over the second half of this year, I think all three of these major developed world economies will be growing in sync, which is why the global growth numbers are so strong. Synchronized recoveries like that have all kinds of knock-on effects, which are really quite positive. What's been driving this, or what's been particularly interesting through this downturn, the size of the fiscal stimulus has been a massive part of the equation in my view. So left-hand side here is just comparing the three recent stimuluses we've had in the US versus the one in 2009. And you can see that virtually every single one of those is larger than the 2009 stimulus. And if you add them all up, it is significantly more. And as I mentioned at the start, as I'll talk about in a little bit more detail in a minute, this has been really key holding households together and keeping income at a really high level and allowing this build-up of savings as people have wound back on consumption, particularly services consumption. Actually, I've got the chart on that is the next one. And you can see this, really very clearly in this left-hand graph, and you can see very clearly the impact that the fiscal stimulus has had on income. So dark blue line there is US personal income, steady trend up over time, right? We hit COVID, and those two spikes, coincide with the checks that were handed out. So it doesn't include, the very latest numbers. We don't have those yet, but you can see the sizable impact that the fiscal stimulus had there in boosting household income. Now, of course, at the same time, consumption fell away as the crisis broke, right? So that gap between income and consumption, which is by definition savings, really expanded. Now, most of the fall in consumption was really on the services side because of all the restrictions that were in place there. Goods consumption, which is the right-hand graph, you can see has really surged. I mean, it dropped away sharply initially, of course, as everybody just stopped. There was just a sudden stop in activity due to the restrictions and the fear that was around, but it's really bounced back very aggressively, well above pre-COVID peaks now. Now, of course, this has been really important for the global manufacturing, the global trade cycle, because goods drives that. As we go into the second half of this year, of course, what we're going to see is a switch in the driver of global growth, right? Goods will be less of a driver, and the services sector will be much more of a driver, because everybody spent on goods because they couldn't spend on services. Now they're going to overcompensate in the other direction and start to spend a lot on services, and goods consumption will come back. So growth will be strong, but it will be a different mix of growth than we've had to date, and that is certainly important for different sectors within the economy. What about the savings? So there's no doubt that there has been a huge build-up in household stock of savings over the course of the COVID-19 recession. Left-hand side here is for the US. It's our calculation of the build-up in US household savings, almost 2 trillion, right? Which is a massive number. The middle graph is UK, where the numbers are also very large, not quite as large as the US, but nonetheless very large. And this has happened across the developed world. So as this savings is spent, that is going to be the big driver of the strong growth that everybody is predicting. What as I said at the start, I do think there is some risk to this story. And for me, the risk is that although we will undoubtedly get a surge in spending and economic activity now, it could fade earlier than people think. And this is really the point of the right-hand graph here, which looks at who has been doing the saving. This is a graph taken, this is data from the UK, but we have similar data for the US, and it tells a very similar story, right? The people who have built up the savings are high income earners, are retirees, and low income earners, unemployed, have not, and have actually in many instances seen savings fallen away, right? As they've lost jobs in the services sector or wherever it may be and had to dip into savings to survive. Why does this matter? Well, it matters because high income earners in economic speak have a low marginal propensity to consume, right? They spend a smaller proportion of marginal income than do lower income earners. So, there's a really open question about, how much of this savings gets spent. And I think that there is a risk that after this initial surge, some of the composition effects of the saving really start to bite, and maybe consumer spending late 3Q, early 4Q is a little bit more modest than the very bullish forecasts that everybody has out there. So just some risk of a dip in growth momentum at that point. The other risk that's out there is this runoff of furlough schemes, less applicable in the US, but it is applicable for much of the developed world. So these furlough and job retention schemes have been put in place, to keep people in work and to keep incomes going. Now, the extent to which this will have an impact on the economy depends on two factors, in my view. One is the size of the scheme, and the second is the size of the amount of disruption to the economy that has taken place, right? The permanent change in economic structure that has happened because of COVID, the permanent job losses that have happened. So it's a combination of both of those. So if you take, if you take New Zealand, for example, huge furlough scheme, but the economy has been pretty isolated from COVID-19, probably hasn't really seen much change at all. So I don't expect there to be a big impact there. The US doesn't have a particularly large scheme, so I don't think there'll be much impact there either. The biggest candidate is probably the UK. That is probably the one to watch. Why? Well, because its furlough scheme is reasonably sizable, and it looks like there may well have been some permanent economic damage there in terms of significant parts of the services sector will clearly have to fold, once the corporate support schemes run off, once the furlough schemes run off. So watch and wait on that. But overall, I think this will be more like a speed bump than anything to really worry about from a global growth momentum. I don't think it'll put any significant dent in the broader growth momentum that we're expecting in the developed world and the globe more generally for that. But it's just something to keep an eye on. UK probably the key one, the canary in the coal mine. That is the sort of picture for global growth that we have in mind. I will talk about what that means for our view on different asset classes in a second. But maybe first I will just jump to some of the work that we've been doing on this inflation risk issue, because I think there is a pretty tight consensus around GDP growth expectations for this year. Where there is not a tight consensus, where there are really divergent views, and where we and other economists get huge amounts of questions from investors is on the inflation risk issue. Now, when I spoke with you last time, I said I think that the inflation issue is underestimated, and I still hold that view. Now, that's not to say that I think inflation is going to happen, but I think it's a risk that is underpriced by markets. Probabilities are always very difficult in this space, right? But if you want me to put probabilities on it, roughly what I would say is I think there is a, say, 10% chance of a high inflation scenario, so something like the 1970s. I think there is probably a sort of 1 in 3 chance of a mild inflation scenario, so something like 3, 4, 5% inflation for a number of years, call it 2, 3 years, something like that. And so there's the majority case is still for no inflation, but again, I think the risks are underestimated. And there's I've written a long paper on this, but there's sort of 2 key points to this. The first is that globalization, in my view, is either slowing down or in fact going into reverse. The biggest issue here is China. Left-hand chart is just some data from the Pew Research Center out of the US, which shows adults in the US that hold a favorable and an unfavorable view of China. You can see the split in recent years. This is a bipartisan issue. It is stronger on the Republican side than it is on the Democrat side, but across the political spectrum, you have this a much less favorable view of China. And that is why, of course, the Biden administration remains quite a hawkish stance on China. But it's not just China, right? I would argue that there are sort of deglobalization movements going on across the world. Brexit is an example of that. There are movements underway in Spain, separatist movements underway in Spain, in Brazil, all around the world. You're just seeing these little movements that are pushing back against globalism, globalization, multilateral institutions. Now that's bad because globalization has been a huge disinflationary force. 1, through cheaper imported goods. 2, through competition for developed world labour, which has meant developed world labour hasn't been able to ask for rapid wage gains. And 3, just through general competition and the productivity that brings. So those channels, less disinflationary. And then the other issue that is going on, I think the domestic political dynamics in the Western world generally are becoming much more accepting of inflation as a potential solution to some of the challenges that we have, and as a potential way out of the fiscal position that we're in. So there's 3 ways to get out of a budget deficit, right? You cut back spending, but that is just not on the political agenda at all, right? There's been a real shift towards bigger government. And I think that's across the political spectrum as well. You can raise taxes, which I think they will, and they are trying to do. The problem is you raise taxes on corporates, that can impact economic growth. If you raise taxes on wealthy people, they find ways to get around it. You know, they report tax in different ways, they work less, they set up tax efficient vehicles, whatever the case may be. The only way to really move the needle on taxes to tax that real bulge bracket of middle income earners, and that's politically costly. So I think they will be very slow to move the tax needle. It's just going to be hard, and that really leaves you with inflation as a way to get out of it, nominal GDP growth, right? So that's why I think the risks of inflation are underpriced by the market. I mean, I would also say that where markets are priced, they're not really pricing in much inflation risk, right? They're kind of assuming that there's going to be no inflation risk for a long time to come. Whether you look at bond yields or whether you look at the multiple that the S&P is trading on, both tell you that story. The sort of second point I would make about inflation is that there's some cyclical pressure coming on inflation in the near term. So right-hand graph here is global IP, which is global industrial production, measure of economic momentum versus G7 inflation. You can see the relatively good correlation there. And that just makes the point, you know, when you have strong demand growth, you tend to have a bit of upward pressure on inflation. So that is coming with the strong growth over the second half of this year. And then in the left-hand graph, just some analysis I did looking at the strength of inflation in the period immediately following a recession. What's really struck me about the last 9 months is kind of how high the inflation numbers have been. So the average monthly gain in the US CPI over the last 9 months, so I'm assuming that the recession ended in June in the US. So from July through to March, the average has been 0.32 per month. And what I then did is I went back through all the post-World War II recessions and looked at the 9 months following the recession, what was the average monthly gain in the CPI? You can see the numbers there. In short, COVID is the highest of all of the recoveries, post-recession recoveries, except for 1973 and the 1980 recessions, i.e. the ones when we had very high inflation, right? So what I think is going on is that you've actually had through COVID quite a lot of damage to the supply side of the economy. And there's quite a few bottlenecks have emerged that have enabled more pricing power than you would expect, given the size of the output gap that we have. So look, it's a controversial topic. Watch this space. You know, key will be underlying inflationary measures. Key will be inflation expectations. If they start to rise, that is a sign that, you know, you have a kind of sustained increase in prices possibly coming through. Those are the variables to watch going forward. But again, certainly I think that markets are underpricing the risk given where they are now. And just to take you through very quickly, we did some work looking at what happens to asset prices in a high inflation environment. So again, I don't think that this is likely. I think a repeat of the 70s is, as I say, about a 10% chance, so it's just more a risk. But just to make you aware of this. So there were really, you know, 3 takeaways from the work that we did. We went back and we looked at the high inflationary period, which we judged to be 1973 to 1982 inclusive. We looked at the performance of asset prices in that period and compared it to the rest of the post-World War II period. 3 conclusions. 1, absolute returns are generally lower. So equities overall averaged 6.2% total return in the high inflation period, whereas they averaged 13.0% in the non-inflationary period. Bonds, 5% in the non-inflationary period, 4.5% in the high inflation period. So absolute returns are generally lower. The second point is that, I'll talk about the reasons for that in a minute, but the second point is that yield becomes a much more important driver of growth, which you can, driver of returns. You can see that in both of these charts here. So price return is in dark blue, and in light blue is the yield component of the return. Generally speaking, non-inflationary period, dividend yield accounts for about 25% of the total return. In the high inflationary period, it was 75%. For bonds, in a non-inflationary period, price effects have been roughly neutral. Average yield has been 5%. That's been your total return. In the high inflationary period, of course, the price effect was negative. So, the yield was well over 100% of the total return through that period. What causes that? Well, this is kind of the third takeaway, which is that multiples are generally more compressed, right? So the left-hand chart here just looks at the average PE ratio for the S&P 500 in the inflationary period versus the non-inflationary period, and you can see 9.6 times was the average multiple through that period. Outside of that period, it's been 19 times. So almost half. And we think that a lot of that, almost all of it, was due to the rise in the risk-free rate. So people tend to think that the equity risk premium went up as well. Macroeconomic volatility rose significantly. Equity risk premium rose. That was a factor. We think that that was pretty mild, if anything. You can see it kind of in the right-hand chart where, the earnings yield minus bond yield wasn't that much different through that period to the period as a whole. And also you can see it in the volatility numbers. So particularly if you look at real GDP, the right-hand chart here, that is mislabeled, that should be standard deviation. But you can see the standard deviation of real GDP growth only went up very slightly. So this is the, in the right-hand chart, this is the two bars, the second category from the left. Real GDP volatility only went up very slightly through that period. And asset price volatility, bonds were much more volatile, equities, not so much. And a lot of other macro variables, there wasn't really a huge change in volatility. So the idea that it's equity risk premium as well, is driven as well, is overstated, I think. So what does this mean? Well, it means that you should be cautious about assets that are on high multiples or that, have a lot of value a long way into the future, right? Because the run up in the discount rate is just going to affect them in a more pronounced way than assets where most of the value is near return. So that's that. We'd just now like to turn and sort of talk about the outlook for the individual asset classes, what we think is going to happen from here. So I think last time I spoke with you, I said that the sell-off in the 40-year bull market that we've seen in bond markets is over. Certainly since the start of the year, right, yields have been rising. I think that continues. The right-hand graph here just shows there's a pretty good correlation between the manufacturing ISM in the US and the 10-year government bond yield. Now, and what that is currently saying is that we should see a really rapid and significant rise in the 10-year government bond yield. I think the 10-year government bond yield will continue to rise. I think bonds will continue to sell off, but not that aggressively. The ISM will probably come down a bit. I think it's probably overcooked at the moment by this goods sector activity that we're seeing. So that will come down a bit. Bond yields will continue to go up a bit, but not as aggressively as they have done at the start of this year. So I maintain the view that I think bond markets are overvalued and you should be underweight. If we do get inflation, then bond markets are really overvalued, right? And you don't want to be anywhere near bond markets. I mean, that sort of goes without saying, or as far away as you possibly can be from bond markets. Equity markets, valuations are certainly high, right? Left-hand chart here is the cyclically adjusted PE for the US, so the Shiller PE. Now, this of course has challenges to it in terms of the valuation tool, because arguably we've got better at managing the economic cycle over time, but it is at the second highest level ever. The only time it was higher was, of course, the 2000 tech bubble. It's currently higher than it was prior to the Great Depression. Does that matter? Based on our analysis, it doesn't really matter for near-term returns. So the middle chart here shows the relationship between the cyclically adjusted PE and the 1-year return, subsequent 1-year return. There's not really much of a relationship, right? It's sort of pretty random. But if you go, it does tend to matter for longer-term returns. So if you go to the right-hand chart here, you can see if you look at the relationship between the cyclically adjusted PE and subsequent 10-year returns, there's a much clearer relationship. So that is really pointing to fairly subdued returns on equity markets. Now, past performance, no guarantee of future performance and all of that. But certainly you would say valuations are a headwind. In the near term, I guess I also think that equity markets have run pretty hard. Left-hand chart is just looking at the S&P since 2009, relative to its trend. And you can see it's sort of well above the trend line at the moment. The right-hand chart looks at the performance of the S&P coming out of this recession and compares it to the median of all the post-war recessions, so how the equity market behaved coming out of past recessions. And you can see again, well above that. So I guess I feel three things about equity markets. One, they've run very hard. They just you just can't seem to get them down. Secondly, valuations are fairly high, without doubt, by any historical standard. Thirdly, though, I don't really see any catalyst on the horizon for a major sell-off of equity markets. Economic growth is going to be good. Earnings is likely to be healthy. Doesn't seem to be anything disastrous unless the bond market really took fright, or unless there was, a sudden surge in COVID again around the world. But beyond those risks, there's not an obvious catalyst for the equity market to fall. So my general outlook is for the equity market to deliver fairly subdued returns for a while. So, more like low to mid-single digits rather than high single digits or low double digits. What asset classes do we like? We certainly like infrastructure. This has been an asset class where investors have been underweight for a long time. It's a pretty small asset class. Left-hand graph here just looks at large pension funds and their asset allocation to cash and to alternatives in general. And some of the work we've been looking at is around this pushing out the risk spectrum idea, right? So as global bonds in recent times, global bond yields in recent times have fallen to such low levels, and there's some huge percentage of the global bond market trades with a negative yield now. I think the latest number might be about 20% or something. So as that's occurred, there's a theory that investors push out the risk spectrum, right? And they push into other asset classes, equities or whatever that bids up the price, eases financial conditions more generally, and that this is why central banks do what they do. This is why central banks buy the long end. It is to push investors out the risk spectrum, to ease financial conditions more broadly and provide an economic system. But has that actually been happening? And we found quite a bit of evidence to suggest that it has. So fixed income investors have added to duration. They have added credit risk in a search for yield. And large pension funds, life insurers, the type of assets with long-dated liabilities have been pushing more and more into the alternative space. I think in part driven by this pushing out the risk spectrum, probably in part driven by an initial underweight, the good performance of alternatives. But we think if we don't get inflation and if bond yields kind of remain around current levels, this process will continue. Infrastructure will be a beneficiary of that. The right-hand graph, though, is just making the point that if inflation does come, infrastructure has a really good hedge against inflation. Top chart just looks at infrastructure's relative performance against listed equities and bonds. When developed world inflation is above those thresholds along the x-axis, and so above zero here is outperformance. You can see an outperformance in every scenario. We've also done work looking at how infrastructure performs when inflation surprises on the upside, because arguably that's what matters most for asset prices, given they're a forward-looking variable. Again, you can see that unlisted infrastructure does sort of better than equities. It has a really good inflation hedge aspect to it. So we kind of think that infrastructure should play on real interest rates. If real interest rates remain low, whether it's because nominal interest rates remain low or whether it's because inflation goes up, that is good for the infrastructure space, and we kind of think that will remain the case. Central banks are kind of telling you that they will keep real interest rates low. That's essentially their messaging. Now, if that was to change and real interest rates started to rise, it'd be a different story. Property markets, an asset class that I guess I have mixed thoughts on. So, on the one hand, valuations, people talk about being, very, very stretched. within the property space generally globally. And of course, there's a million different property markets globally, but there's a generalization. In this slide, what we look at is office cap rates across the world in the major cities across the world. The grey bars in each of these charts are the 15-year range. The blue line on those bars is the latest data point, and the black line is the 2007 low. So at the cyclical peak last time, what was the level? And what you can see on the left-hand side is that cap rates are indeed very, very low, right? Much lower, generally speaking, than the 2007 low even. So that would point to overvaluation. But in the right-hand graph, what we do is we then look at the cap rates relative to bond yields, and then the picture changes quite dramatically, right? What you see is that current spreads over bond yields are not actually that low, either relative to the 2007 levels or just generally relative to the range over the last 15 years. So in absolute terms, of course, valuations are high relative to other asset classes within the, less so for property, right? So we think that's a bit of a mixed picture in terms of what the economic environment or the economic outlook implies for asset prices within the property space. Generally speaking, when you have strong GDP growth and when you have reasonably stable interest rates, property does well. And in fact, when the yield curve steepens, property markets generally do well. And the yield curve, the shape of the yield curve, it has some leading indicator properties on property prices generally across the world. And I show three different asset classes here. So US multifamily, London offices and Sydney offices. They all kind of tell the same story, which is that the US yield curve is steepening. That is good for property. And then lastly, of course, borrowing costs have fallen. That is due to the fall in the risk-free rate, but also some of the spreads that the property markets face have come in as well. So, there are good reasons to be reasonably constructive on property. That said, there has been an absolute boom in property in many parts of the world, particularly in coastal regions around the world. So people have left the inner cities and gone to coastal regions. So there's a big difference there. But in some places, prices are up sort of 40% over the last 9 months or so, which is some pretty heady rates of growth. And so that makes sense. Overall, I think property is not a bad place to be. Returns should be okay, need to be selective. You do need to be careful, be wary of the frothy type areas. But overall, I would think you would get better returns in bonds, better returns in equities, and probably not quite as good of returns as you get in the infra space. That's it on the major asset classes. Just in the time I've got left, I thought we would touch on some of the themes that I mentioned to you last time that we are focused on, and just see to what extent they may be playing out. And then I just thought I would talk also a little bit about the air travel sector, just quickly, because I think that is one that is changing. So last time, this was what I said to you last time. We said air travel would be slow to recover from COVID. We think that remains the case. I mean, that has held true for sure. It has certainly, air travel has been much weaker than other transport sectors, whether it be ports, whether it be roads. Air volumes have remained very suppressed. We said that supply chain reorganization could hold down trade growth. That certainly hasn't happened, right? Trade growth has absolutely boomed, courtesy of that strength in goods consumption that we've seen. I guess we still hold this view, right? We tend to think that over the longer term, you're going to see some supply chain disruption as globalization pulls back and people become more worried about geopolitical risks, and that will just contain trade growth. So the trade growth to GDP growth multiplier is something we've done a lot of work on over the years. It reached a peak of about 2 in recent times, so call it, early 2000s, late 90s, early 2000s. So trade was growing pretty much twice as fast as GDP, as production fragmented globally, which turbocharged trade. That was the whole globalization process. So we don't think it's going to be 2 going forward at all, because those tailwinds are going away. That said, it rarely goes below 1. The last time it went below 1 for a sustained period was the 1930s, which were just hugely problematic from an economic and political perspective. And look, we think globalization is going into reverse and things are getting a little bit tricky going forward, but we're certainly not going back to the 1930s. So look, depends on the port and depends on the type of good that the port trades, the locations that it trades to, etc. Every port is different. But as a generalization, we would say a multiplier somewhere between 1 and 1.5, 1.25, 1.3 is a sort of reasonable working assumption for most ports over the longer term. Shift to online continues, accelerates, as you're all, I'm sure, aware. There's been a steady shift to online over time. People have really doubled down on that in COVID because they've had to. And we think that is a structural shift to an extent. Of course, online shopping will pull back. It already has. I'll show you a chart on it in a second. But we think there has been a structural leg up in online shopping. Working from home increases. That has happened. We hold that view. To throw some numbers at you, the property guys in our team have done an entire paper on this. The team could send it to you if you're interested. But pre-crisis, people worked on average about half a day from home per week. We think that number goes to about 1.5 per week, 1.5 days per week per person. What does that mean for office demand? It means that office demand is weaker than pre-COVID trends, but it doesn't mean that office demand goes negative. Again, if you're interested, we could send you that paper. Automation and technology ramps up. This is a longer term view, but things seem to be heading, generally speaking, in that direction. We also said that the green revolution would hit a speed bump but continue. In some circles, I think this was a controversial view because there was a view out there that as COVID hit, incomes contracted, we wouldn't be able to afford the green revolution, the subsidies that are necessary to maintain it. But in point of fact, through the crisis, people have really doubled down on their green investments. Governments have doubled down on their green investments. And one of the key differences we think this time around as compared to, say, the GFC downturn is the price of a lot of the green energy generation technologies, solar and wind, have just come down so much. And in most cases, levelized cost of energy basis, they are lower than the fossil fuel generators like coal and gas. Again, I'll show you a chart on that. Regulation intensifies. There hasn't been much on that front, but that is probably, again, a sort of longer term trend that we think is going to unfold. So just to round out lastly with some of the charts that I mentioned on those themes, the bottom right chart here is that levelized cost of energy point that I was making, that in a lot of the green space now, the cost of energy from wind, onshore, offshore, from solar is well below the cost of coal and gas. The one major exception is probably Japan, where that's not the case, but in most other geographies, that is now true. And that is why governments, we think, are holding on to that and in fact doubling down on it, in addition to, of course, all the growing concerns around climate as an issue. Top right chart is e-commerce sales as a percentage of total. You can see the spike there that happened courtesy of COVID. It has come back a bit, as I mentioned, but we do think, again, that this is a structural uplift. There's data for other developed world economies around which show a similar picture. You can get data for Australia, for example, which tells you the same picture, same things going on in the UK. Very last point before I just jump to see if there's any questions, and would really encourage you to ask questions, is around air travel. We do think that we are at an inflection point for air travel. Air travel hasn't picked up at all through this COVID crisis, basically. There has been some recovery in domestic air travel in the big land masses. So in the US, there has been a recovery in domestic air travel, less so in international. In China, there's been a really strong recovery in domestic air travel, almost no international air travel. And in Australia as well, pretty good recovery in domestic air travel, nothing in international. But with the vaccines now being rolled out, we're talking about vaccine passports, right? There is talk here in Europe that there'll be a bridge with the US open up for those that have immunity for this summer. We think that the actual international side of air travel could start to recover now. It'll take some time, and growth in business travel may be somewhat subdued or somewhat weaker over coming years than it was sort of pre-COVID. But the bottom left-hand chart here just makes the point that air travel has some really good long-run drivers. Rising income in the emerging world, rising income in general, is really correlates strongly with air travel. The richer people get, the more often they travel. Travel is really a sort of marginal consumption option of choice for middle income earners. And so as things return to normal, you'll start to see that growth return again. So you'll get a bit of a solid jump up as the vaccine rollout happens, and then a return to sort of normal type growth rates, certainly on the consumer side. And that is a markedly different picture from where we are now, where there's hardly any international travel taking place at all. So we think that is a place that is really going to change quite dramatically over the next, call it 6 months or so. So that's it from me. I'll stop then, and if there are any questions, though, I'd be very, very happy to take them on any of the topics that I've covered on today, or just in general.
Thank you, Daniel. We do have a couple of questions here. One, and recognizing we're Michigan folks, how do you see the green revolution impact the transportation sector, particularly the automobile industry?
Yeah, so obviously a lot of focus on electrification, in this space. And all, car companies are rolling out electric vehicle models left, right, and centre. It's the only area where, there has kind of been growth recently. Number of challenges, though, of course, around cost. Cost is coming down all the time, no doubt about it. Battery costs are coming down all the time. But electric vehicles, are still reliant on subsidies, to fuel their growth, to make them cost competitive. So I think cost competitiveness will still take a little bit of time. The other challenge, I guess, is sort of trucks, long haul trucks. And that requires just an enormous battery to work. So I think cars, the growth in electric vehicles will remain reasonably strong for a while, although I suspect that some of the growth numbers that are in there, which are very strong, that analysts have, are probably overcooking it. I think the truck story will take ages, if it ever comes. I mean, trucks could go to something other than petrol before they go to batteries, I think. So that is much more challenging.
Thanks. And circling back to your infrastructure slide, what are your thoughts and insights on the Biden infrastructure plan?
So very interesting. A lot of governments during recessions go for infrastructure spending, and I think it makes sense for a range of reasons. One is that infrastructure tends to be quite labour intensive, so it provides a good boost to jobs in the near term, which is what you want in a recession. But secondly, infrastructure can be productivity enhancing, right? So it can be good for your longer term growth dynamic. So, is it wise for the Biden administration to be doing a fiscal easing through infrastructure? It's one of the best ways to spend money, spend government money. There's lots of ways to spend government money. In my view, it's one of the best. So from that point of view, it's a good thing. Does the US need it? Yes, it does. Everywhere could do with an upgrade on infrastructure, and the US is no exception in that regard. Does it sort of massively change like private market infrastructure dynamics? Like, not a huge amount at the moment, because most of the money that is being allocated towards these projects is public money, right? There's not a lot of private sector involvement. But, we do think it will raise awareness. We do think it will steadily but surely raise liquidity in the private market space. And look, in time, there could be opportunities come along for private market players, to get involved in infrastructure projects, whether it be with government or on their own, whatever. So definitely a positive. So positive for the US economy, definitely a positive for the infrastructure sector, but perhaps not as positive as it would be if he announced a plan that sort of combined public and private sector money to do greenfield projects and working together. But like, maybe that will come down the track.
Okay. All right, looks like that was the questions. We were lucky to have you last year's thoughts and then contrast it to this year's thoughts. So that was very helpful for all of us. And thank you for being here today.
Yeah, no
So
problem at all.
Okay, cheers. We have a few announcements just to close out. For MAPERS, our next webinar, Understanding the Annuity Withdrawal Interest Rate, is going to be presented by Foster and Foster. That's scheduled for Wednesday, May 19th. Registration information is available on the MAPERS website. Additionally, MAPERS is going to be hosting 2 socially distant outdoor networking events this summer. On Thursday, June 24th, we're hosting Tigers Night at the Detroit Athletic Club in Comerica Park. And on Monday, July 19th, we're hosting a golf outing at Tamashannock Country Club in West Bloomfield. So information for both of those is posted on the MAPERS website, and space is limited. So try to sign up quickly if you are interested. Don't wait. If you or your company are interested in sponsoring a webinar, or if you have a speaker or a topic that you've seen or thought of and want to suggest to us, please reach out to the MAPERS office. So thank you for this. On behalf of the MAPERS board, we wish you and your family and all your colleagues good health and safety. And thanks for being here today.